But demand among retail, among institutions is just not there. When sentiment changes, then that is one whole new wave of buying that will come in. And I think the central bank buying is going to continue, not at the same rate it did last year. I don't think that at all. I think we'll see this year. I think this year we'll see net buying,
Absolutely.
strong net buying, but considerably less than last year and the year before. But when we have a new wave of buying from Western investors, institutions and retail, then I think gold and silver both are going to move meaningfully this year.
Gold prices faced selling pressure last week as investors sought the dollar's safe haven appeal, driving prices down over 1% to a one-week low. This decline was fueled by increased dollar and U.S. Treasury yields, compounded by hot inflation data that heightened risk-off sentiment in the market. However, despite the dollar's ascent, gold prices rebounded on Monday's opening bell, climbing above the $2,300 mark. The gold chart, measuring spot prices, showed it touching the $2,320 threshold in the day's trade, surging nearly 18 points or 0.80% in the last 24 hours. This bullish run indicated an increase in the risk appetite for gold among commodity investors worldwide. According to legendary investor Adrian, gold's recent journey has been remarkable, with its price skyrocketing from $2,000 to $2,400 in just 3 months, even as the dollar maintained its strength. Despite a slight retreat to around $2,300, gold has shown remarkable resilience, largely thanks to robust demand from central banks and Chinese savers seeking refuge from economic uncertainties. Central banks' purchases of tons of gold have given retail investors confidence to trade, driving their risk appetite. China, the leading precious metal buyer, has pushed its prices up in the indices. Developing countries like Russia, India, Brazil, and South Africa have also accumulated billions of gold this year. Adrian notes that concerns about economic stability and limited investment options for Chinese investors have led to a surge in gold purchases. With traditional investments facing uncertainties, gold stands out as a preferred choice for wealth preservation. Of particular note is that the global physically backed gold ETFs saw their 10th consecutive monthly outflow in March, losing $823 million. Despite this, Adrian anticipates a potential surge in buying once sentiment shifts among Western investors, which could lead to significant movements in gold and silver prices by the end of 2024. We will present clips from Adrian Day's interview with Wall Street Silver. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
As everybody knows, we went from 2,000 to 2,400 in basically 3 months. That's an astonishing move for an asset like gold, especially when the dollar was staying strong. So it wasn't caused by the dollar collapsing. For an insurance asset, a defensive asset, to move like that is really astonishing. We all know the reasons. I won't go into it. So we pulled back from the 2,400 level. We're now just above 2,300 as we talk. But again, that's not surprising given the move we've had. And I would characterize it as gold is really resisting dropping. Or in the US, it's dropped in one of those markets and then slowly recovered, some ground. So it's really resisting dropping. And I think, frankly, that just speaks to, the demand that's out there for gold. So what I see for the balance of the year, as we've said, at the moment, it's the vast majority of buying in the last 3 months, but also in the last 18 months, but particularly, let's say, this year, has been central banks and Chinese savers.
Right.
We shouldn't ignore the Chinese savers because, they're concerned about their economy, they're concerned about the yuan devaluation, and they're concerned about the fact that China might be introducing easing measures. And they're looking for a way to protect their purchasing power. And they're not going to put their money in a bank. They're worried about the banking sector. They're not going to put their money in real estate, which is where Chinese people traditionally have put their money. And they're not going to put them in stocks with the stocks as low as they are. Some of it's going into stocks. We've seen a rally in Chinese stocks in the last couple of weeks. But most of it is going into gold. They can't put it into Bitcoin, as you know, or cryptos, they're banned. Right. So most of it is going into gold. And when you look at those two buyers, they are driving the market. They have been driving the market. They have a vast majority of the buying that we've seen this year and central banks for last year.
Right.
When we see, as we will, when we see a shift in sentiment among Western investors, that's institutions and retail, which we haven't seen yet. Remember, we talked about this last year, the outflows from ETFs. We are still seeing more outflows from gold ETFs than we're seeing inflows, which, given what gold is doing, is really quite astonishing. We're still seeing very low premiums on coins and low deliveries from mints. Mm-hmm. So the demand among retail, among institutions is just not there. When sentiment changes, then that is one whole new wave of buying that will come in. And I think the central bank buying is going to continue, not at the same rate it did last year. I don't think that at all. I think we'll see this year. I think this year we'll see net buying, strong net buying, but considerably less than last year and the year before. But when we have a new wave of buying from Western investors, institutions and retail, then I think gold and silver both are going to move meaningfully this year.
Last year, there was widespread belief that the U.S. economy was on the brink of a recession, but that prediction didn't materialize. Fast forward to this year, and the prevailing consensus is that we might experience a soft landing, where the economy slows down without plunging into a recession. However, there's a growing contrarian view challenging this notion. Andrew Hollenhorst, the chief U.S. economist at Citi, is doubling down on his contrarian perspective. He recently stated on Bloomberg TV that he foresees a hard landing for the economy. According to him, inflation and labor market conditions will deteriorate to such an extent that the Federal Reserve will be compelled to slash benchmark interest rates 4 times within the year, far exceeding the expectations of Wall Street, which anticipates only 1 or 2 cuts. Adding to this viewpoint, Adrian Day shares a similar belief about the inevitability of the U.S. heading toward a recession. He draws attention to the economic disparities, emphasizing the challenges faced by lower-income groups compared to the affluent. Despite the Federal Reserve's hesitancy to reduce rates amidst prevailing economic data, Adrian foresees a rate cut later in the year due to further weakening economic indicators. This suggests growing concerns and a challenging path ahead for the economy.
I think the U.S. is heading towards a recession. I don't think we can avoid it. Mm-hmm. But 2 things on that. One is, the lower half of the income are in much more trouble than the upper half, and particularly Absolutely. The upper 20%. So when people say to me, well, the economy's doing great, I say it might be doing great for you, but it's not doing great for 50% of the population. That's one thing. And we've said this before, but when you have ultra easy money for so long, and we had ultra easy money from 2009 all the way through to 2022, and particularly after COVID, but you've got that easy money for so long, and interest rates, they were zero lower bound in the US for a long period of time, where people could borrow money, particularly if they had collateral, at very low rates. Then it takes longer for the impact of higher interest rates to show up in a recession. But everything is pointing in that direction. So I think the economy is slowing, and it's very clear from Powell as well as some of the other Fed members that they really, well, from Powell in particular, he really wants to cut rates, but he wants to do it when economic reports allow him to do it, which they're simply not doing at the moment.
Right.
At some point this year, the economic reports will be weak enough that he can justify cutting. And remember, why he wants to cut, or why they have to cut, I should say, is not because the unemployment rate is ticking up by 1/10%, as he nicely put it, Shame if you're that 0.1% that just got laid off. But anyway, and it's not because the employment, the economy is sort of slowing a bit. It's certainly not because of a stock market, but they have to be concerned about the federal government budget. Right. They have to be. The interest that the federal government is paying on its debt. That's why Janet Yellen went to China 2 weeks ago to beg them to buy our treasuries. Interesting. That's why the Fed announced this week, why Jerome Powell announced that they were cutting back on their QT, on selling down their bonds. Remember, they've been selling them down, not by selling them, but just by not rolling them over. Right. They've cut that program from 60 billion a month to 25 billion a month this week. Why did they? And significantly, he said, we're going to keep the program going on the mortgage-backed securities, but we'll sell fewer. We'll sell fewer. We'll roll over more treasuries. Right. We'll be selling fewer treasuries in the market because they're concerned about the friggin' treasury market. There's no one wants to buy them at these rates. Nobody wants to buy. China's got enough, thank you. They don't want any more. Russia's certainly not buying. Right. And the people that are buying now are the foreign buyers that are buying now are primarily hedge funds that are not looking to buy and hold. That means that supply will be coming onto the market at some point. And they are very price sensitive. You know, they're not buying as a reserve asset. You know, you've got $100 billion to employ. Well, you've got to put it somewhere, and treasuries are an obvious place to put it. But if you're a hedge fund buying through a Cayman or through Brussels, you buy because you think you can make money on the trade in the next month or two. So you want higher rates right now.
As gold edges up to $2,309.705, signaling a 0.36% increase, it hovers near a pivotal point at $2,309.65. Breaking past this level could encounter resistance at $2,328.74, followed by $2,351.65 and $2,378.36. These hurdles will test gold's upward momentum. Amid reports of developing countries stockpiling gold to safeguard against a U.S. recession, it suggests a precautionary measure against potential economic downturns. This points to a potential surge in gold prices as developing nations seek stability. Where are the prices heading next? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.